Okay, so the first quarter of 2023 is now over, and as most of you probably would rather forget, 2022 was a rough year for investors almost across the board. Major indices closed out the year anything from 12% down for the NZX through to 33% down in the case of the Nasdaq Tech Index, and New Zealand house prices were down around 14% from the start of the year. The inflation genie was well and truly out of the bottle, and central banks spent most of the year cranking up their rates in an attempt to get things back under control. So by the end of the year, there were some slight indications of that working, but one source of major concern for many investors and economic commentators was the US yield curve, which ended the year squarely negative. Treasury markets were signalling strong expectations of recession in the mid to near future, and that theme has really continued into 2023, with the US and New Zealand yield curves still well into negative territory. Since 22 closed out, a lot has happened, and data in 23 so far really has been all over the place. As mentioned, inflation data in late 22 was starting to show faint signs of moderation, which sparked a big rally in equity markets in Q1, with the US SPX index gaining nearly 10% between the start of Jan and early Feb. Unfortunately for the bulls, consumer expenditure and inflation data that dropped in mid-Feb, followed by a hike and some pretty blunt messaging from the US Fed in late February, really did put a pin in the euphoria, causing the SPX index to crash back down around 8%.
With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
And in New Zealand, GDP readings for quarter 4 22 delivered a pretty big surprising decline, down 0.6%, although that drop has to be seen in the context of a 1.6% improvement in June 22 and a further 1.7% improvement in September 22. Then came the shock collapse of Silicon Valley Bank on the 9th of March, quickly followed by Signature Bank a few days later in New York, and the forced sale of Credit Suisse in Europe. Now, market reaction to that was fairly strong, certainly in the financial sector. That pushed the SPX down a further 3%, although at that point it was still up on the start of the year. So in the 6 weeks or so since then, it does appear that that has been a relatively isolated event, contained to a handful of banks carrying some quite specific risk, and volatility in equity markets has really settled down a bit since then as markets have sort of come to grips with the situation. Now, the Fed did hike again in March, and equity markets have actually bounced back quite strongly as more signals have started to emerge of US inflation slowly coming under control. So headline CPI was slightly under expectations this week, and manufacturing and labour market data is also showing signs of easing. As of this week, the SPX is up around 8% since the start of the year. The Nasdaq is up by around 20%, and the NZX is up by around 3%. So that brings us to the RBNZ shock cash rate decision on the 5th of April. They delivered a 50 basis point hike. That was double the widely forecast expectations of a 25 basis point increase. And that's taken the OCR to a 15-odd year high of 5.25%. Now, the bank has pointed to a number of reasons for this. So they've talked about persistently high, sticky core inflation, further inflation expectations off the back of the repair efforts after Cyclone Gabrielle, OPEC out of the blue, their oil production cut in March, and that's led to a 6% jump in the price of oil. In particular, they singled out sinking international interest rates and the risks of those flowing through to lower mortgage rates. And I think that's really worth highlighting, that the RBNZ was very clear that one of the main drivers for a rise so much larger than expectations was their concern that retail banks might start lowering interest rates. So just to restate that, the RBNZ raised rates because it was worried that retail banks here might start dropping mortgage rates. So if that doesn't send a clear message that the Reserve Bank wants retail mortgage interest rates to stay high, then I really don't know what will. Now, what's been particularly interesting here is the divergence between the RBNZ and the Reserve Bank of Australia, which the day prior to the RBNZ's rate hike had made the call not to raise rates in Australia at all. Now, to be clear, the RBA has not said that this is the end of rate increases in Australia, and there is an expectation that more might come. but they are charting a markedly different course to New Zealand. So they're taking a much more measured and wait-and-see approach. So I think on reflecting on this surprise hike, I do think that it's just as much about sending a message as anything else. So we've seen almost no movement in retail mortgage rates so far, fixed or floating. Markets have been anticipating a terminal cash rate in the ballpark of 525 to 550 basis points for a while now, and there wasn't any expectation really or indication that that would change as a result of the 5th of April decision. So yield on New Zealand debt and NZ equities haven't really moved materially since that announcement, and it actually does appear that markets have generally taken that hike in stride. Okay, so let's talk about bond markets and what they're saying about the future. Now, bond markets are usually considered to be relatively safe, at least in terms of volatility. So bonds rank above equities in the capital structure of a business, and they deliver a contracted flow of income in the form of interest payments, usually at a fixed and agreed rate. So if you own a bond, then, and assuming that the company or the government that issued the bond doesn't go bankrupt, you can just hold onto it, and ultimately you'll get your money back with the contracted interest payments. So if you want to trade the bond, though, before its maturity date, its valuation will be affected by prevailing market interest rates at the time. So generally speaking, if the market interest rate is higher, then the value you get from selling your bond will be lower. So when we look back at the last sort of 18 to 24 months of equity markets performance, there's clearly been some good-sized downward movements. But I think in the grand scheme of history, the last year or so's slides in value in equity markets really haven't been that big. So the GFC, the 1980 stock market crash, the Great Depression in the 30s, the initial weeks after the COVID outbreak, the 2000 tech wreck, these all came with significantly larger movements in equity markets. So compared to these periods, 2022 ranks as a really relatively mild and orderly correction so far. So, but it is a different story in bond markets. So as central banks have been going through the quickest increase in rates in history in many parts of the world, that has led to a historically large decline in bond values. So when you add the recent banking failures into the mix, that's driven some of the highest volatility in bond yields and bond prices since the 1980s, really. So what this means is that the outlook for interest rates seems fairly uncertain. Now, the US Fed has been very clear in its messaging. So they have stated very clearly that they do not expect rate cuts in 2023. And the RBNZ here has been pretty stoic on this front too. So they've given very little indication that they expect rate cuts in the near term. But if you compare this to where US and NZ yield curves sit, where bond markets have been pretty clearly pricing in expectations that central banks will be forced to change tack before the end of the year. Now, this is a significant divergence. So markets have a very different view of where things are going than central banks. And at the end of the day, someone's going to be wrong. So if we look at economic forecasts, we can see a similar level of divergence. So this chart here shows forecasts from 21 different economists and sort of institutions that cover New Zealand. And each of them provide their forecast of where RBNZ interest rate paths are going to go. And each one of those is on a separate line on this graph out to the end of 2024. So the range is highlighted there. You can see there's a pretty wide dispersion with estimates for late 24 ranging as low as 275 basis points and as high as 500 basis points. And there's a pretty wide range of paths to get there as well. And it's the same with US forecasts. If we look at the Fed, the 24 range in yields there is pretty similar or even wider, from 2% to 6%. And again, with a fairly messy path to get there. So the New Zealand mortgage curve today is looking very, very flat, perhaps slightly negative for a couple of the main banks. So there's been very little movement in rates in the last few weeks. Banks have seemed to have chosen to really hunker down in the wake of the SVB fallout, despite all the goings on in bond yields and swaps markets, which is kind of fair enough. And I will stress also that these are retail published rates. So in many cases, borrowers may well do better than this, depending on how attractive they are to a bank, basically. Competition in the mortgage market has been pretty hot as borrowing levels have dropped off, and we've seen banks making tweaks to credit policy and extending offers of cash incentives and privately negotiating on rates in an attempt to win business, even as those margins are staying tight and uncertainty has been staying high. So I would say that the 50 basis point OCR rise has probably cooled off the appetite of main banks to lend or to lead with big rate discounts, but we are still seeing competition, and we're also seeing things like cash incentives staying fairly attractive for new borrowers, certainly good quality borrowers at the moment too. Now, one of the big concerns that has been looming in recent months is the fixed rate cliff. So this refers to the wall of lending that's currently on fixed rate terms of 12 months or less. So that's mortgage debt that's currently on a fixed term rate that will expire in the next 12 months and move to what is almost certainly going to be a new interest rate that was a lot higher than it was. So I did touch on this briefly in our January update, but here's a chart that shows the volume of lending. Now, I've split this chart in two, so it's a little clearer. The blue areas show lending that expires in more than a year's time, and the red areas show lending that's either floating or expires in less than a year. So as at the end of February, slightly under 60% of mortgage lending in New Zealand, so this is for owner-occupied properties, by the way, it excludes investor and commercial lending. So slightly under 60% of that lending will roll off a fixed term and be refixed at a higher rate. So depending on the original loan terms, that could mean a rate increase of anywhere from 1% to as high as 4%. So this is a lot of lending. Here's a quick look at this by total loan value. Again, this is just owner-occupied properties. There's no investment or business or commercial lending here. So as of February this year, total mortgage lending value was almost exactly $250 billion. Now, in terms of cash flow impact, an $800,000 mortgage taken out today at 6.3% per annum will cost over $1,300 per month more than an $800,000 mortgage that was taken out a year ago at 3.5%. So that's a big cash flow impact when you are directly comparing the two, and you can see pretty clearly from that why house prices have taken a hit, and that cash flow hit still really has to come for a lot of people. So now, it's worth saying that there's a lot of mitigants that people can and will put in place here. Discretionary spending will slow. They'll stop borrowing elsewhere. They'll look to substitute out to cheaper brands. They'll look at restructuring their lending and interest-only lending and things like that. There's a lot of things that people can do and will do here. And keep in mind also that unemployment is at historic lows and wage growth has been strong. So while this is going to be a tough slog for a lot of people, it's not necessarily symptomatic of a big impending crash. In fact, reduced spending, lower economic activity, lower growth is exactly what the RBNZ is trying to achieve by raising rates. So lowering economic activity in order to reduce that inflationary pressure. And now we do see this pressure continue to build in terms of mortgage arrears. Centrix released their March credit report a few weeks back, and the standout numbers there included mortgage arrears climbing for the 7th month in a row now standing at slightly under 1.3% of total lending. So that's 23% higher than this time last year. But keep in mind, again, that is historically low by pre-pandemic standards. Okay, so let's take a look at the Arrears House Price Index report. Now, the most recent as of the date of filming this is February 23. That was published on the 14th of March. Headline numbers from that report showed that the national house price has fallen by around 14% for the year to date. Auckland's down a little more than that at 17%, so the regions have been holding up somewhat better. Interestingly, Auckland house prices have dropped now to the point that the average house price growth there for the last 5 years has only been 2.9% per annum. So the average for New Zealand overall is around 6% per annum, which means that on average you'd have seen a better return investing in the NZX over the last 5 years versus buying a house. Now, how about yields? Well, as with bonds, normally there is an inverse relationship between prices and yield. So as prices fall, yields go up. Rents in New Zealand are at all-time highs at the moment. According to the Trade Me Rental Index, the median rent in New Zealand went over $600 a week for the first time in Feb, up 4.3% since Feb last year. And rental supply is down too by 9% nationally and a pretty significant 23% in Auckland. Okay, so some thoughts on what all of this means and implications for borrowers and buyers and sellers and investors. Now, as always, these are general comments, okay? So in my view, property investment carries similar levels of risk to investing in the stock market, and the stakes can be even higher when you throw leverage or property development risk into the mix. So please don't make any investment decisions off the back of one random video on the internet. If you're thinking about making financial decisions involving real estate and particularly borrowing, please talk to a professional first. Okay, so look, my general perception right now is one of high tension between buyers and sellers. So listings are at long-term lows and buyers are feeling very firmly in the driver's seat when it comes to pricing. But I don't think vendors seem to be under significant pressure to lower pricing at this stage. Now, buyers are going to be feeling some pressure from higher rentals on average. And I think memories of the last kind of couple of decades or so of rampant house inflation will start creeping back to front of mind over time. If prices start to reverse and start heading higher again, I don't think it'll take long before that sort of fear of missing out could take hold again. But overall, right now, expectations of further price falls, I think, are keeping buyers very value focused, and buyers do seem very willing to drive a hard bargain. Now, where I think this is showing up in particular is segments of the property market that are quite homogenous. So central city apartments might be a good example, or new developments where stock levels are fairly good and properties are fairly similar in terms of spec and location and quality and such forth. This is where buyers are really going to be able to crank the screws down on price. So for more unique, desirable properties and locations, though, I think the lack of supply is going to continue to keep a floor under pricing in the short term. And while sellers are being squeezed by rising inflation and certainly by rising interest rates, there still aren't any material signs that we're seeing of seller stress that would cause a more comprehensive collapse in pricing, basically. LVR restrictions that have been put in place over the last decade or so have gone a long way to keeping owners safe in terms of equity. Certainly it's done a lot to protect their lenders, and labour market strength and wage inflation is helping with that interest rate pressure as well. And we are certainly seeing more and more instances of property developers and property syndicates, investors that are running into trouble. There's certainly plenty of property owners, though, who are still out there in good, strong financial positions with good, strong balance sheets and good, strong cash flow that I think probably are able to weather more of a downturn without bending too far on prices. So by and large, it does feel like you've got buyers and sellers that are really stuck in this high-stakes game of chicken right now. And ultimately, where this ends up might just come down to who blinks first. Okay, so that's all for this update. I hope you found it useful. We'll be putting together a brief update like this on the property market and borrowing environment on a more regular basis, probably quarterly, so keep an eye out for those, plus additional pieces we've got planned over the next wee while on investing and building long-term wealth over the next few weeks. So thanks very much and see you then.